Right, lads and ladies, let's get straight into it. Interest rates, something interesting. See what I did there? And before we get into interest rates, we need to understand what is an interest rate and who makes them, who creates them, who uses them, how do they affect us average Joes. So, in terms of interest rates, we're talking about the federal funds rate in particular. However, the interest rate um, in the UK or in Europe is just set by a different central bank, but does the same thing. So the one we're looking at today is the federal funds rate for the US. Why? Because the US is a reserve currency of the world, so that's where we're going to focus our attention on. So what is the federal funds rate? The federal funds rate is an interest rate at which depository institutions lend balances held at the Federal Reserve to other depository institutions overnight. You can read through this in your own time. Just have to give you a quick definition. I'm going to break it down now. Basically, in simple form, in simple terms, the way banks work, banks have to have a certain amount of reserves, is what they're called, in their at the end of trading day. Excuse me, sorry. Banks need to have a certain amount of reserves at the end of the trading day. But what happens if they fall short or if they have a surplus? So if they fall short, but then they need to get that money from somewhere because they can't close the bank, they can't end the day with not enough reserves in the bank. That's just a rule. That's a rule they have. It's a rule that all the central banks have. It's a way of regulating the banking system. But what happens then if you fall short? Because the reserves is always going to change because you might have one person walk in and take 150 grand cash out of the bank, but then that's after going down. Or you might have a wire transfer of 2 million quid after going out. Those transactions are constantly going through. So at the end of the trading day, before the bank shuts, it needs to make sure that it has a certain amount of reserve there in case anything happens. So what does it do? If it doesn't have those reserves, it has to borrow those reserves from a different bank. And if it does have those reserves, or if it has a surplus of those reserves, more than what is required, but then they can lend out that surplus, and then in order to get a return back on their money, and that is the interest rate that we're talking about. That is the federal funds rate. But that's not where it stops. That is how it's implemented, and that is where it comes from. But it goes far beyond that. It goes into them. How does it affect us? It has a ripple effect through the economy. So it's not just for banks. If banks get charged more to do something, well, then they're going to charge us more to do something. It's just that kind of producer. If I'm getting charged more, I'm not paying that bill. You're going to pay that bill. The customer is going to pay that bill. Excuse me. So what interest rates do we have? You have an interest rates on your savings account up here to the right. I have an interest rate in your savings account. So it really depends who you are. Are you a saver? Are you an investor? You have interest rates on your bonds. How the interest rate affects your bonds. You have your business loans, you have your mortgage repayments, and you have your debt repayments. So start out with savings accounts. If you have, say, for example, a million quid in a 5% a year return savings account, that means you're making 5 million quid regardless of anything. Just your interest that the bank is paying you for holding that money in the bank is 5 million quid per year passively because you're holding it with them. But what happens then if that interest rate goes from 5% down to zero? But then there's no incentive for you to hold your money in the bank there anymore. So why would you hold your money in the bank when you can get 0% in it, when you can hold it in the S&P 500 and possible to make 8 to 10% annually on that same million quid or whatever it may be? So that's how it affects savings accounts. But the more money you have, if the interest rate goes to 5 to 10%, well, then that's going to make you put more money into the bank because you're making more money, and it's safe as well. It's not in S&P where you might make 8%, but you might lose 6%. You know what I mean? You're holding it in the bank, so it's a safe bet. It's a safe option. But when the interest rates fall and the interest rates go down, there's your issues because people don't want to save anymore. So they start taking the money out of the bank. They start taking the money out of US equities, and they start putting the money into other assets. And then we have bonds. So what is a bond? Really quickly, essentially, a bond is just an IOU from the government. So if you have 100 million quid and you need somewhere to put it and you need to make a return on it, what safer place to put it than with the US government? They can't do you over. And if anything goes wrong, they'll print more money. You're never going to go wrong with the US government. See, the issue with the US government bonds are, if you have a bond at 5%, lovely, happy days, that's your bond there. But what if the interest rate goes from 5 to 7%? They're fixed rate term bonds. So that doesn't mean that your 5% bond goes up to 6%. That means any new bonds that are issued goes up to 6%. So your bond loses value because the new bonds are worth an extra percent. So if you take your money from your old 5% bonds and you stick it all your 100 million quid into a 6% bond, you're still making an extra 1% buffer, and your 1% of 100 million quid is a lot. Don't think about it too much. It's not that important, but just said I'd let you know what it is. Business loans. The way the economy works is with a lower interest rate. That means that it's cheaper to borrow money. If we have a 5% interest rate, we're just going to stick with this example. If we have a 5% interest rate and the interest rate goes down to 2%, it's going to incentivize people to take more money out, to take loans out, to buy that car that they were wanting, to go on that holiday, to expand this business, to build that factory, to employ more people. They wouldn't do that if they were getting charged 5, 6, 7, 8, 9% for the same loan. So we go into it in a minute, but when you lower the interest rates, it makes borrowing cheaper, and it makes the flow of money around the economy flow quicker and essentially grow. You have mortgage repayments for your variable rates. If you're not on a fixed rate term mortgage, which means when you sign your mortgage and it says you're on a 3% fixed term rate, that's handy, that's 3%, that's it. But if you're on a flexible term mortgage and it goes from 3% to 5%, well, then your monthly repayments are either going up by 2%, or if it goes from 5% to 3% or 2%, well, then your monthly repayments are either going down. And which also again incentivizes people to buy more houses, to get mortgaged out at a lower interest rate, at 1 or 2% interest rate. Lower, people might want to buy more houses and expand their real estate portfolio. And then you have debt repayments. Is on these bonds, we have to pay. All these bonds are is debt. It's an IOU from the government. So now the government owes something like $38 billion, but at an interest rate, I think it's 3.75% or something like that, something along the lines, whatever it is, it's adding out to about $1 trillion a year. So if the US government can get the interest rate down to zero, although they still have the loans that they have to pay back, any new loans or any new money that they create, new money that they get, they essentially pay no interest. So they're just printing that money out of thin air, getting it for nothing, paying it back for nothing because the interest rate is zero. So the debt repayments now by the US has exceeded the amount that they spend on their military. I think the military is something like 850 billion a year, and their debt repayments is $1 trillion a year, which is an outstanding amount of money. But that is how interest rates affect. That is what interest rates affect. So now, if we go, how does interest rates affect the dollar? With a higher interest rate, let's go for the dollar. Why? Because it makes dollar-denominated assets more attractive. So like I said, if you have 2% return on your savings, you might not be incentivized to hold your money in the bank. But if you're getting a 10% return on your savings, but then that's going to make it give you a lot more incentive to hold your money in the bank. See, when we're thinking about this, we need to be thinking big term, big money. We need to be thinking, don't think of you with your 100 grand in your bank or 1,000 quid in your bank. Talk hundreds of millions and billions of dollars. That's what these people are holding in US bonds and equities. So you have as well then, that's how it affects the higher interest rates go for the dollar. Why? Because it makes the dollar more attractive to foreign investors. And then you have low interest rates, the complete opposite. A low interest rate is bad for the dollar. Why? Because it makes the dollar weaker against other currencies. If you have a low interest rate, people are going to start pulling the money from these US assets, and they're going to put them into somewhere where they can get a better return on them, whether it be stocks or whether it be whatever it may be, real estate, anything, whatever it may be, cryptos, anything. But the key is that they're going to take it from the dollar, weakening the dollar, and they're going to put it into something else. Now, I'll give you an example now. So you have if we know how the interest rate affects the currency that we're trading, and we know from our video previous that the correlation between the dollar and whatever currency or whatever asset is being traded against, whether it be a commodity or another currency pair or whatever it may be, if we know how an interest rate will affect the dollar, and we know how the dollar is correlated with other assets, well, then we know how the other assets should move in correlation with the dollar as the interest rates fluctuate higher or lower. So that's why they're important to understand, because if you know that a high interest rate means that that's good for the dollar, and you're looking at Euro USD, and you know that the interest rate is out there going up 25 basis points, but then you can safely say that if it's either going up, I mean, our high interest rates are good for the dollar, but then we can say that the Euro USD chart is going to go down. Why? Because the dollar is getting stronger against the euro. It's important to note when we're talking about interest rates, we're talking about basis points. So you'll find the interest rate is never set. It's never going to be, I think it's 3.75 to 4% or 3.5 to 3.75. But when we're talking about interest rates, we're talking about a buffer. So you have, it goes up in points, basis points they're called. So 1% is equal to 100 basis points. So a lot of the time they'll use fancy words, big words and letters, and you won't understand it, but it's simple, it's piss easy. It's just to make the layman, the average bloke, not understand it. 100 basis points is just 1%. If they cut it by 50 basis points, it's 0.5% that they're at the cutting in. 25 basis points is 0.25%. They usually go in, not usually, they always go in 2.5% increments or 5% increments. Or like that, you know what I mean? They never cut by 30%. Excuse me, at 30 basis points, they can't, it only moves in 25 basis points increments. So you can drop it by a percentage, but you can't drop it by 90%. Why? Because 90 isn't divisible by 25. Simple. But yeah, that's how they'll do it, 25 basis points, and it'll be a range, so it won't be 3%, it'll be between 3% and 3.25%, or between 3% and 3.5%. That's the buffer they'll give you. It won't always be one number. It will show up as one number, but when you look into it, there will always be a buffer. Where did we go? The way the Federal Reserve works is they work off a dual mandate. So a dual mandate that they have is to keep inflation low, relatively low, around the 2% mark, and jobs high. We see the fucking English, man. The reason that's difficult to do is because it's like a balancing act. The more money people get, the more money people spend. So the more money people spend and the more money people are making, the more money flowing around the economy. Stick with me. And the more money flowing around the economy means there's more money chasing the same fixed amount of goods. So what does that do? That causes inflation. So prices slowly, steady start to rise, and that's no problem. Inflation is not a bad thing. Everybody thinks inflation is the worst. It's not a bad thing. Steady inflation is a good thing. It's a sign of a growing economy. Hyperinflation is a bad thing. That's when everything gets way too expensive. You can't afford it. Fuck all. Your bread is out there going up 1,000%, and you can't afford anything. And you see this happening in countries across the world. I can't name them off the top of my head. Like, you see them making photos and all out of their money, painting their money and using it to blow their nose and all, because it's worthless, because that hyperinflation, because they weren't able to manage that act. Yeah, and the more people spend, and the more people make, the more people spend, that causes inflation to rise. Yeah, it's central banks, like I said, that control the interest rate. The interest rate isn't only for the Federal Reserve. The Federal Reserve is the is the central bank in the USA. The European Central Bank in Germany is the one that controls the European rates, and then you have the UK. I'd imagine it's just the Bank of England that control their interest rates. When borrowing is expensive, businesses stop building factories, etc., and expanding. So the way it works, simple like a thermostat. If the interest rate is high, that's a way of slowing down the economy. Or if we are getting into that hyperinflated state, a way we can slow down the economy is to higher the interest rate. Why? Because it stops people spending, it stops people borrowing, it stops people buying shit that they don't need, and it slows down the economy back around to our 2% inflation target. And then obviously if you're going into a recession, like you've seen before in the past, what the banks will start to do is they'll start to lower the interest rate, so people start to spend their money again, so people start to circulate that money around the economy again, and then we slowly start to creep back up. And see, it's like they work against each other. See, if you hire them too quick, you get hyperinflation, but if you lower them too quick, well, then you go into a recession. So it really is a balancing act, and it's very important to understand the interest rate and how it affects, because it doesn't just affect people. Just think, oh, it's the interest rate just affects the banks, and they'll read this here now on and they'll say it's depository institutions, so just banks lending to other banks, and that is it. That's what the federal funds rate is, but it has a ripple effect throughout the economy, and that ripple effect will soon affect every single person, all of us. Everybody will be affected by it, indirectly, directly. Everybody will be affected by it. So if we look here, for example, we have, as well, we have, I'll leave this down below. This is just a more in-depth version. I'm just going to run through it fairly quick. Let's say, for example, where we have the federal funds rate, and federal funds rate, 1.25%. Federal funds rate. This was March 2020. Would have been just around after COVID. We dropped from 1.75% to 1.25%, which, if you were listening, is a drop of 50 basis points. And then here, this will tell you everything you need to know. I'm not going to run through it now because I want to show you this as an example. So if we see this was the March 3rd, 2020. Let's jump to our chart here now, and let's jump to March 3rd, 2020. Get rid of this so it's not all slow. You know, actually, let's start with the DXY to make it easier to understand. In and around March 2020. It's fucking slow, man. So we can see here, when we get a lower interest rate, which we know is bad for the dollar, that causes the dollar index to go down, losing strength. So if we know that the dollar index, now this is a daily chart, it's cherry picked data, but just to give you an understanding of how it works. Like these moves, this is a daily chart, so these moves are huge. Like, so we drop down when the interest rate is low because the dollar is weakening. People are pulling that extra, that's 0.5% that they're either going down from 1.7 to 1.2. That 0.5%, it may not be a lot to us, it's less than it's a half percentage, less than 1 full%. But the people who have millions and billions and whatever, trillions of quid, this affects them a lot. So if we see that when we get a rate cut, price goes down. This is the dollar index. So if we say when we get a rate cut and price goes down and the dollar weakens, what can we say is going to happen with gold? We could argue that gold is going to go up. Let me just get the correct charts. This one, I believe. Yeah. Same time in and around March. This is a little bit further. I think it was early March. So you're talking more down here. But you can see the direct inverse correlation that it has. A lower interest rate, people are pulling their money from the dollar and they're sticking it into commodities or safe haven assets like gold. Then you see gold rise. And then we have, let's take EU, for example. Hardware losses. Fuck's sake. Fuck's sake. Now, so if the Euro USD chart, if we know that the dollar is getting weak, well, then we know that when the dollar gets weak, that means that the euro is getting stronger against the dollar. So what's going to happen to the Euro USD chart? It's going to go up. Why? Because when the base currency gets stronger against the pro currency, price goes up. Simple as. And now if we go back to around, where's this, 11th of March? Fucking me, man. I hate slow technology, like. Fine. Now here we have on the Wednesday, the 16th of March, we have price went from, the interest rate went from 0.25% up to 0.5%. So we went up 25 basis points. What does that mean? That's good for the dollar. Why? Because that 25 basis points means that if you're holding money in a savings account or something like that, well, then you're getting more money back. So it entices people to go back and use the dollar. So if we know the dollar is getting stronger,